week's highlight is tomorrow. We've got inflation and the numbers are expected to creep up a little bit, but it's probably going to take something super hot to prevent the Fed from going in December. Quick argument here that I think is pretty easy to follow along with. Firstly, nothing's changing on the risk radar. We had a decent little bounce back in MicroStrategy at the end of the day in crypto too, so Bitcoin still and crypto green, stocks still green. Maybe if we really break down through 6, that light for green on stocks will have to go yellow, but let's talk bonds and the dollar here. The yellow lights have had on there reflecting the general chop as we have to balance a few things. We definitely have to balance the Fed's desire to cut and the market's desire for the Fed to cut with the general resilience of the data. Our economic data have been solid, they've been consistent, and there's a very real possibility the policy happening next year could improve it even further or possibly stoke inflation. But all that still is really in the realm of speculation. What we know right now is that the beat rate of economic data has cooled a tiny bit in the last few weeks. We haven't really had any big blockbuster numbers to make the Fed worried about cutting or a rise in inflation, reflation. And so generally markets have been pretty calm for bonds and the dollar. That being said, though, the 10-year and the 2-year still are elevated. If you look generally over where we've been over the last couple months, we have seen a little bit of a tick up, but nothing that's going to, I think, derail the situation at all. Let's keep going here. Next one. Looking at generally the way the dollar is trading next to bonds, you have had a pretty strong bid into the dollar. So the fact that the dollar is still held up, I think, means that this might be kind of the last cut. But the thing right now is that there's really just not a lot of reason for Powell to be worried about cutting when the market's demanding it. When you've got so much uncertainty for next year, you might as well at least lock one in. Kind of the same argument about making the 50 basis point move before November because there's uncertainty around that to actually just to swing the bat hard and make it work. And that's what they did. The same kind of logic here applies because there's a lot of uncertainty next year what's going to happen. Trump and his team have said that they're not going to tamper with Powell and try and move him out of his position, but who knows? I mean, anything's possible. There's a non-zero possibility of pressure on the Fed in some way or the other. And so for Powell to see the market giving him the clear, he's going to do it. If you look at the odds of the cut, they have steadily risen. So even though we've gotten a little bit of a bid into the dollar and a little bit of bid into yields, which you can see on the odds, judging from CME's Fed Funds futures, the odds have kept going up. So this was a day ago, this is a week ago, this is a month ago. That steady rise in conviction for the cut, despite the fact that the dollar has been elevated, yields have kind of been sideways, tells you that the market is pretty convicted that this is going to happen. And I think that makes sense for Powell to do at least one more to set him up for next year. Maybe he doesn't do any next year, but we haven't had any big surprises in the data. Inflation is expected to warm up a little bit from the last reading, but still generally he can point to the disinflation of the past year and continue on with his plan, unless for some reason something tomorrow's wild. But I would get ready for the status quo.